Hello and welcome to this Thursday session on trading the trend. Question every week: what trends are you riding? Now, you might be riding some bullish trends, also might be riding some bearish trends. We'll talk about both here as the Nasdaq is under siege, at least in the semiconductor space, Meta among others. So we'll talk about that. So just real quick as we get started, we've got Connie Hill with us in the chat. We welcome her, and all of you here today. We welcome Bill with us, Wiley, Kevin, Dom, JP. Will Wacky Whack 6650, Jay Palin 3673, Melissa, and many others. Aloha, Scott, back to you. Just real quick as we get started, remember Connie and myself, all of us coaches, we do post educational content on X. So those are also educational examples and announcements as well. So just join us there. Quick reminder that when we talk about examples, we will talk about stocks and options. If you have questions maybe about different topics like futures or ETFs, those are in different classes. We won't talk about those or trade those in this class. ETFs will be tomorrow at 9:30 a.m. Eastern. I'll be teaching that class solo. If you had interest, let's say in futures, Ben Watson teaches that on Tuesday. But our class here will be on stocks and options. Now, when we talk about options, remember that options carry a high level of risk and are not suitable for all investors. Different types of options, different pros and cons of each strategy. And also remember when we talk about examples, we will teach from a point of view, we're trying to teach from general informational purposes only. When we talk about our examples, we will do those on the Paper Money software application. Investing involves risk, including loss of principal. When we talk about examples, if we talk about, let's say, short selling, we talked about that. We'll bring up the Disney example. That's more of an advanced strategy, potentially a limited risk, may be done in a margin account. Now, I bring that up because some investors might not trade options, but they might say, look, I think the stock might go down. And also today, we'll talk about the NASDAQ first, and we'll talk about some examples in the semiconductor space and gold and Meta that are under pressure. So I want to start just kind of real quick on what we're kind of seeing. Let's kind of bring up first off, since we're on it, since we're on, so we don't have to change back, gold a little bit under pressure. Okay, had a pretty big bounce back from about 4,100, went up to 4,600. Pretty volatile move. 10% off the bottom or so, checking back here today. Now keep in mind, some people might trade gold stocks, or maybe a grouping of stocks. That area is still under pressure. When you look at, let's say, silver kind of looks like it's maybe forming a longer term or intermediate descending triangle, which, obviously had that big move up to 121 or so. When I say descending triangle, I'm saying horizontal support, maybe somewhere there with that downward sloping resistance. So some of that move in silver might not be done yet. Now, again, someone might try to trade the silver price or something that tracks it or tries to, and or silver companies. We might get into that. Now, when we talk about the indexes, let's go NASDAQ now. Here we are. We are within stone's throw of making a fresh new low. The NASDAQ has been trailing the other indexes, struggling to get back above that 24,466. Now, Ben Watson teaches the class on index options, like NDX, like buying puts on NDX, ETFs. Someone might say, I know a ticker symbol that is trying to track the NASDAQ, the index itself. You know what that is. We're not going to do that because that's outside the box of this session here. But the biggest thing is we want to talk about some individual stocks that might be driving down that performance. Now, of course, if we said the NASDAQ, you're actually thinking maybe what about semiconductors? And that brings up another point is that, maybe someone might just say, look, I think the semiconductors are going to struggle a little bit. Well, what is the ticker symbol for that grouping in general? Okay, that's tomorrow. But if we talk about this class and these ticker symbols, and the reason why we go top down is we want to kind of know what are we likely going to be seeing, bullish examples or bearish examples. If we actually said, well, what's in that space that might be a little bit under pressure? I'm going to kind of start off with the example of NVIDIA. Okay, now this is not the only one. If we brought up, let's say, and let me just show the group, Market Watch, we're going to go to visualize for just a second. Now, if I brought up, let's say, Market Watch, Visualize, and on the left-hand side, S&P 500, we go down to where it says Information Technology, okay? Now we're talking about the sector, and you're seeing that semiconductor and semiconductor equipment. Now, a couple of those names, Micron, AMAT, LRCX, et cetera, they're under pressure. Now, we'll look at AMAT, we'll look at NVIDIA, et cetera, but I'm going to start with NVIDIA. I'm going to start with NVIDIA first, okay? Now, NVIDIA's had some pretty good news, but the pretty good news or great news has failed to really cause investors to knock the price higher or push it higher. Now, as an investor, now I need to ask you a question. How many of you feel like if someone said, do you do bearish positions? Can you type in the chat? How many of you do bearish positions? Put yes for you do bearish positions and for no, you don't do bearish positions. Type that in the chat. Now, I went over, for example, recently, like shorting stock. I'm probably not going to go back to that here today, but I use that short stock. This, again, like we saw in the disclosures, that's in a margin account only. Now, I'm going to date myself here, okay? Not just by the wrinkles on my face, but when I started, I mean, I didn't know anything about options, so I was very, very, very familiar with shorting stock. And I didn't have an IRA or anything like that time, retirement account. Use margin accounts. And so that shorting stock is how I kind of got started. I was going long and short, okay? This is 25 years ago. Yes. Now, if you take a look at this, if someone said beyond this, what might be that stepping stone? Short call vertical, okay? Long put vertical. And we're going to kind of focus on these bottom three. The short call vertical, less upside, more probability, okay? Higher upside, okay? Less probability. Okay, now, 4, we'll add this here, short synthetic, okay? That short synthetic, you could actually say to some degree, is really a combination of the number 2 and 3. It is a short call vertical plus a long put. So when you get a short call vertical, that's the credit, right? That's the probability side. The long put, that's where you're trying to say, look, I think the stock's going to go down and I want to have a higher potential upside. The short synthetic and the stock or shorting stock are similar because the delta is higher. Okay. Now, you want to be aware. So I want to kind of just see in the chat. I just want to see when I ask the question, how many of you are comfortable with actually, okay. So Jeff actually says no. Jim actually says rarely. I'm like a Russian bear. Sorry. That was funny. It totally took me off. Now, short call vertical, Richard says. Okay, yes, no. JP Allen says no. Okay, so I'm going to say that there's more often than not. This is why kind of a lot of our examples are more on the bullish side. We're going to look at both sides. But why would I, if I was a bullish investor, want to know about bearish trades? Well, because you want to at least identify, you want to see what both sides, both traders are actually looking at. In other words, if we were in a bullish position, we saw the trend starting to go down, we know what's going through those bears' mind, and they might try to put on bearish positions and knock the price down. Okay? So you don't want to just see it from your perspective only. That's like in marriage. That probably is not going to work very well. And in the world of investing, we want to see both sides of the trade. A bullish investor, what they're thinking, bearish investor, what they're thinking. Now, with our idea here is on this, we're going to kind of first focus on number 2, okay? Short call vertical. So when we do short call vertical, we said less upside potential credit. That's the credit we get, the max gain. And there's more probability, meaning the stock, it's a little bit, that trade's a little bit more forgiving. If we actually come down into the trade tab and we bring this up for just a moment, and I'm going to go to the 15 May. So many of these positions we have are in the April expiration cycle. I'm going to go to the May. And what I'm going to do in this case is I'm going to go to, let's say, the 185. Okay? Now I'm on the call side. If we sell the 185 call, we're actually saying, look, we think the stock could stay below that strike. Think of whatever strike you sell as that's the resistance. Okay. Now we're going to put this in the paper money account so we can track it. Going to bring up NVIDIA here. Pull this up. And there we go. Now, what I'm going to do in this case is I'm going to right click right on that 185. Right click. Okay. Sell. And we're going to go right to vertical. Okay. And we'll come back to the shares in just a moment. But if I right click on that, sell vertical, you're now going to see that we're selling the 185 and the 190. Now, we have a decision. What's the decision? That decision is, do we want to do a $5 wide strike or a $10 wide strike? Well, I mean, you can't assume they're going to be liquid. Double check. If we did the 195, are they liquid? 68,000 contracts. So if we did one contract, there's a pretty good chance we can maybe squeeze in there. I'm joking. Probably a really good chance. Okay? Bid-ask spreads 3 cents, 10 cents there. Now, if I pull this up, what you're now going to see is, well, how much risk can we take? Well, if we said we could risk $1,000, we could do 2 contracts of the $5 wide or probably 1 contract of the $10 wide. So if I do the 185, 195, that's when we look at this and kind of see the break even, max profit, max loss. I'm going to widen it out to do the $10 wide. We check the bid-ask spread on the 195, saw that, and we're going to push it there. Now, this is a bearish trade, okay? So when you're in a market that's more volatile, you might, and let's say you normally have 12 or 15 total positions, could 3 or 4 of those positions be bearish? Yeah. What type of bearish positions? We mentioned 4. This is built-in max credit, max profit, and the max loss is defined. So even if it went up to $1 million, given the vertical, built-in max loss, $728. Okay? Now, this might not be the main thing of what you're really looking at, but sometimes you do see stocks that could be under pressure, and you're saying, hey, I'm having less upside potential situations, and I'm going to use some of my capital, not as much. I'm going to use some of my capital to enter in maybe some bearish trades. Now, just real quick, are there any questions with that? Okay. So when we talk Wacky Whack 6650 says, when you say probabilities, what are we talking about? Well, it's the odds of the stock being above or below the strike price. Okay. So if we sell the 185, statistical probabilities is the stock being 1 penny above that 185 is 36%. 64% chance that it could be below. Okay. So when we get into trades, investments, you want to know what those odds are. Okay. Now, we pulled up an example here. Okay. I'm going to come back to, so first off, any questions? Okay. Now, comment from Mickey Visco 8245. James, love bear credit spreads, but why not use on a day when it is almost down 5% for the day? Well, it's kind of it's an interesting question. Okay. If we do, let's say, a short call vertical here, which we did, the delta, negative delta. Why is it negative delta? It's a bearish trade. So in other words, let's say if it's down $4 today, okay? Well, why not wait for it to be only down $1? That's the whole point of verticals, is that you might say, look, I might be a little late-ish to get in to do a bearish trade. But if it goes up $2, $3, it's not going to be as material as just doing shares by itself. That's the point. So if we said, yeah, we're already down 481, we missed the boat. Well, if it does go back up $2 or $3, it's probably only going to be losing about $40. Not really material. That's kind of what's nice about that. Now remember, if you do a stock trade, bullish or bearish, the timing is more critical. With the verticals, you could be a little off a little bit, and it's probably not going to matter as much because the delta is lower. Okay, now, comment says, why are you bearish on NVIDIA? It's based on what I just said, right? You look at some of the news we've actually had lately with the stock, you would think it would actually push the stock price up, but it hasn't. And if we look at on the right-hand side, what do we see on the price graph? you're going to see that kind of we have this low, we have another low, we have another low, we have another low. What do you call that if we're starting to get lower highs? Well, if you get so many lower highs in a row, and all of a sudden, you're pressing down on that support more and more with more weight, the chances that you go through the floor support is higher. Now, I think one of the hardest things to also kind of understand is, so we have a position at 175, okay? Shares. And you're looking at this and saying, you know what, I'm down about $1, 116 bucks. I don't think the chances of that going up are very good. Now, nobody likes to lose anything, but there is a point where you say, I want to really get my cash back because I don't like the trend that I'm in. Okay? Now, as people, we really love to someone says something to you and it just bounces off you. You don't want to really internalize what that person is saying to you or what the market is showing you. So what I'm going to do on this NVIDIA position is we're going to sell the shares of stock. We're just going to fish and cut bait, okay? Saying we don't like that trend right now. We don't like the momentum, which it's had a lack thereof. We're going to create a closing order, and we're just going to sell those shares. We're saying, look, I'd rather take a small loss and try to get in something else that has more of a trend, okay? Create closing order, sell. Now, if I do that, go to, let's say, mid, I'm going to try to push it to the mid price. How much are we down? $108. Material on the account? No. Okay, confirm send the order. So the moral of the story is we're saying, look, I want to get out of a position where that trend is starting to look pretty nasty. Okay? Now, nobody wants to have big losses, and nobody wants to have small losses. Here, what we're trying to say is we'll take a small loss to try to avoid a price pattern that typically does not have a good outcome. We're trying to get out ahead of where this maybe breaks through the floor, okay? All right. Now, the comment came in. I think we hit that. Now, and also go back to just real quick. So, example trade number one was a bearish trade on NVIDIA, okay? Now, I'm also going to go back to, let's say, a couple stocks here. And let's go back to Amazon for just a moment, okay? Now, if you're a bullish investor, you might be saying to yourself, well, James, I know what I'm waiting for, but I'm just it's not doing what I wanted to do. And sometimes that happens, okay? Now, the one that I kind of mentioned yesterday that some investors might be watching is a stock like Amazon, okay? Now, if we look at, let's say, when the earnings is, that's on 430. When you're in a more volatile market, using buy stop orders, buy if it gets to this price or higher, or buy stop limit, buy if it gets to this price or higher, but it puts a limit on what it's able to buy for. Now, sometimes when we see these positions when they're flagging back and they're going up near the area of resistance, well, what we might see in this case is, hey, could we maybe set up like a buy stop, okay? Now, when we do a buy stop, we define the resistance and we're adding 1%. So if I actually said, well, where do we see the resistance? Well, if I just went to the nearest dollar, we're going to take 212, I'll define as resistance, add 1% to that, and that's going to give us a number. That number becomes the order to buy at or above that price. Now, I'm going to tell you right now, this is so foreign to some people, okay? You're telling me that if it goes to that price or higher, that the paid money account is going to try to buy. That is correct. Because if it goes to that price or higher, the idea is, could that stock be breaking out to the upside? Now, we've said this before. If it goes to that price or higher, does it guarantee it's going to go up? No, it can hit that price and go right back down, which means you got in at the shorter term high. Sometimes that actually stock hits that high and keeps going, okay? Now, a lot of people don't like this because number one is, A, it's buying at a high. Number two is, well, the risk is it could buy at 220. So what we're going to do is we're just going to add a cap. We just call it a limit, okay? And we're going to say, look, you can buy up to $1 higher than that buy stop price. How'd you get the buy stop price? Define the resistance, add 1%. How do you actually define the cap price or the limit? Add $1. So what that's allowing this to do is to buy in between 214.12 and 215.12. This is the range that it's able to buy. Okay? So it can now here's the deal. If that stock gaps up to 216 and never comes back down inside that range, it doesn't fill. Okay? So you got to get filled in there. It can't be any higher than 215.12. And now what I'm going to do in this case is I'm going to right click on the chart. Okay? Right click on that chart. Where's that 212? Okay, buy custom with OCL bracket. We're going to come back down to this. We're in the IRA account. First off, let's go limit, buy stop limit. We're going to put the prices that we wrote on the chart. What do we say? Or write down 214.12. Where do you see that? Right there. And remember, what was the cap price? Now, James, do you always do $1? Yeah, most of the time I'd say 50 cents or $1. Now, if you go narrower, 50 cents, the range is tighter. When the range is tighter, you have less probability of actually maybe getting that, so that's a risk. So we naturally kind of tend to widen out by about $1. Maybe on a lower price dollar stock, 50 cents, okay? Higher price dollar stock, maybe more than $100, $1, okay? Now, we're going to do this dated GTC because with that GTC in this case, we're saying we don't know if it's going to fill today, tomorrow, Monday, and so on, but this will be an ongoing pending order, usually giving them about a week to see if they can fill. Now, when we go to target price, I'm going to put a target price right kind of at this old support area, about 228. Okay? Remember, the target doesn't matter until there's a fill. Same thing with the stop. We have to get a fill first. Okay? If we looked at where that midsection is or support area, really got about 207.87 less 3%, 2%, excuse me, 203.71. No, Lisa. If we come back to this, 203.71. Okay. Now, got to go back to the position sizing, right? So if we set on this account, how many shares? Now, I'm going to do it in the margin account just so we can verify that it's going to fill. We're going to take this actually to about $4,100 or so, which is 10% of the capital. It's going to be 19 shares. 19 shares, target, stop, confirm, send. There it is right there. Okay. Now remember how the stop works. Sell stop. Okay. Sell it if it goes to that price or lower. The sell orders are not applicable until the purchase is made. Okay. Send. And now what you see is that order is just sitting right there. So as a bullish investor, sometimes you're saying, I know what I'm looking for. It's not doing it. I have my pending order set. I'm just waiting to see if they can fill. Okay. Now, if we go back to just real quick, the comment says, JB, why not go with the April expiration on the NVIDIA short call vertical? The answer is, when we get into Monday, you're seeing that would actually be like 18, 19 days to expiration. We're trying to have a little bit more time for that trend to develop. I mean, once you start getting below 20 days, you got to imagine if you start with 20 days, you're not trying to go to zero. You're trying to get actually, let's say 20 days and maybe try to exit with 5 days remaining. Okay. So just trying to give a little bit more time. The idea is we're not trying to go to expiration. You go to all the expiration, the bid-ask spreads are wide. Okay. And we're trying to sell something when there's some time remaining. Okay. We're not trying to take it to the bitter, bloody end. As we get out of our mind, we're trying to get out probably 5 days to expiration. Tighter bid-ask spreads, okay? Greater chance of it. Now, I also want to go back to, let's go back to just real quick, Dell, just want to take a quick peek. Dell did not actually hit the target. You're seeing some selling off on that. We talked about the stop there. What is that stop? We talked about that yesterday. Won't go into that. But overall, that did go up to 186. That was a brand new high here today. We talked about the stop adjustment using the Fibonacci. That was yesterday. Keep an eye on that. I'm going to also go back to just real quick Apple for just a second. Now, Apple, if we take a look at this, they've come out with some different products as of late. Prices actually come down to the 247, got some upcoming earnings. Now, as a bullish investor or bearish, you like to kind of have something you could shoot towards. The investors speculate on what they think the earnings is going to be, good or bad. Now, what I'm going to choose in this case, let's imagine the investor said, James, I want to buy the shares of the stock, but I really don't know for sure which way it's going to go. Okay. Now I'm going to try to get this filled in the IRA. Okay. And now what I'm going to do is, now remember, this is going to take more capital to do this, noted. But I think many stock investors might say, look, I'd like to buy some things, but I just want to be a little bit more protective of capital. So number one is we're going to try to buy the shares of stock. There it is. Okay. Step number two, we're going to go to single order and go first triggers SEQ, meaning do it in a sequence. Step one, buy the shares of the stock. Step two, we're going to say, look, we want to sell a call where we think that stock might not be able to get above there. Okay. Now, if we look at this, the 265, if we agree to sell those shares now, we get up to 265 plus the premium. Why are they paying you? For the agreement that you'll cough up the shares, okay, at 265 from now until expiration. Okay. Now, if we decide to sell, why do we look at that one? Well, if you buy something, you normally like to sell at a higher price. Well, how high? Well, A, we can look at the chart and see where do we think resistance is, or two, we can just go look at the delta column and say, what's the odds of the stock closing above that strike by a penny? Our range that we normally look at is a delta of 30 to 40, okay? So if we buy these shares at 255 and agree to sell those shares at 265, that's $10. Now, step two, how do you sell the call? Click on the bid. Now, if we bought the shares, sold the call, that is a covered call. That's an income strategy. That's not a protection strategy, okay? Now, in this scenario, the investor is not concerned about necessarily the stock shooting to the upside and crashing to the upside. I think many more investors would be a little bit more concerned about the downside. Now, what I'm going to do in this case is we're going to analyze that trade. Now, when we do this, it's just going to show us, in this case, the shares of the stock, okay? This diagonal line right there, that is showing the profit loss diagram. It's a 45-degree angle because that slope represents, for every dollar we go up, it's $100. Why $100? Because you got 100 shares. Stock goes down $1, you're down $100, okay? So when you have a 45-degree angle line like that, highly likely, or if not, you have shares of stock. The steeper the line, the more shares, okay? The greater sensitivity to direction. Now, if we added that second piece, the call, that is going to create the cap. So now if you take a look at this, if we sell the call, you're now going to see that we have a cap. Now, boo, we don't like a cap. Well, maybe we do. Well, maybe we don't mind the cap, okay? Maybe in this market, we don't necessarily think it's just going to go up to infinity. We think there could be more neutrality in the price. Now, that blue line, that's the cap. That line goes flat right at the 265-ish price level because we agreed to sell the shares there, okay? Now, if we look at the delta of like a covered call, this covered call, the delta is 42. Now that delta is not going to stay the same. It's going to change with price movement. It's going to change with volatility. And it's going to change with days expiration and so on. But there's a positive theta there. Okay. The con about selling the call by itself is negative vega. We talked about that on Tuesday. Okay. Now that concern is, well, James, what if it goes down? So, well, that's what we're going to do. Now, in the words of someone that I talked to, and I said this before, but it's always still funny when I think about it. I asked the person, why didn't you buy a put? And the person quickly responded, because I'm cheap. And then the voice came from the background. Yes, he is cheap. I tell him to stop being cheap. Okay, now I'm not a marriage therapist, so I couldn't really go into that comment from the spouse. But the biggest actually thing is if we went back to the trade tab. Now, by the way, I tend to be a little price conscious as well. I don't think that was bad what the guy was doing though. Now, if we take a look at this, we're going to come over here to the put side. Whatever we pay, whatever we collect from the call, we're going to try to use to fund the put. Now, in this case, we now have in this, we're going to use that 695 to buy that 240, okay? Strike put. So what this now does is it gives us the right to sell the shares at 240. Now, why would you want to exercise that right? Or why would you want to use that put? The main answer is probably because the stock is below the 240 strike, okay? So when would you want to say, hey, I want to use that? When the stock is below or set to close below that long put strike. Now, here's what a lot of stock investors out there, they do not understand. That long put is making there's a floor on the position. So it can only get so bad. Who controls that right? The person who bought it. Who bought it? Well, in this case, paid money account is buying the put. The put does not go out into infinity in time. It's only until the 15th of May you have the right to sell the shares. So what you're going to notice is if we get in right here and the stock were to go down, 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 we're just following that line down, 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 down. And if that stock were to go to the left or down, we're just getting a bigger and bigger piece of that maximum loss. Do you realize that your life is on, you are a point on the curve? Do you realize that? Okay. You're on the curve to expiration. Okay. You're on the curve to that financial goal, whatever it is. Well, in this case, we're on the line to the maximum loss. If the stock were to go up, we're on the line to the maximum gain. So in this case, we have a maximum gain about $1,200 or so, and a max loss probably right about $1,400 or so. Now, guys and gals, using this is very important. Now, why would someone do this? Okay. Well, in a market that is more volatile, doing strategies that have a higher delta to them can be more risky. So the investor might say, I'm going to choose strategies that are not as high, positive or negative. Okay. So this strategy has a delta 25. Okay. So the stock goes up $1, 25, another $1.25, down $1, negative 25, plus 25. Stock goes down another $1, plus another 25. Why plus? Because the stock's down? Well, it's because, well, no, is that true? No. Just think about the protection. That stock goes up $1, you gain 25 because you got positive delta. Stock goes up $2.50. Okay. Stock goes down $1, you be down 25 net-ish. And if you go down $2, you would be down overall about $50. It's more forgiving. Guys and gals, as investors, you're creating your own personal volatility because we're just picking strategies a lot of times that are too blasted high given market volatility. Okay? Remember we said before, the height of the VIX is like the height of the waves on the ocean of the market. If we have high waves, you might say, James, I'm going to pick strategies that are not as sensitive to price. Okay. And I think sometimes we can be hard-headed in there. Okay. And I can just say that it took me a while to learn as well, but I'm just saying, hopefully today we kind of knock through there and say, geez, maybe I should consider dollar cost averaging, maybe consider strategies that are not sensitive to direction. Okay. So what I'm going to do here is I'm going to try to get filled. I'm going to try to put that in the IRA. If it doesn't, I'll fix it, confirm, send. Now, remember, we don't have a stop. We have a right to sell those shares at the strike price. Now, think of this like a vertical, which in some degrees it is on the diagram. If we got a certain percentage, 50, 65, 80% of the maximum gain, could we trade this like a vertical? Yes. If we actually had if the stock was set to close below that long put strike in the week of expiration, could we just get out prior to the expiration or try to? Yes. Okay. So now I'm going to try to get it filled. Oh, I took it. There you go. Okay. Now, so here's the deal. When we look at the buying power of this, it's really coming back to the buying power effect of the shares. Okay. There you go. Okay. Now, I want to also go back to just one other example. We'll take a look at now a couple of these stocks. Let's just look at this for just a second. Okay. If you look at stocks like Microsoft, my goodness, under pressure. Meta, wow, just take a moment there, soak that in. Okay, pretty big drop. Now look at the stocks like Adobe. Now the previous CEO, he stepped down. He or she stepped down. I think it was he stepped down. New one came in. Stock really hasn't reacted. You got a stock like, for example, like DoorDash. You look at that stock hitting some fresh new lows. You get a stock like Google under pressure. You get a stock like Lulu, okay, under pressure, stretchy pants and all. And if we look at, let's say, Disney, which still is going down, okay? Now, super quick, just real quick. So first off, in trading the trend, the goal of the investor is probably just to make money. Fair? Now, whether it's up or down, I'm not sure if that matters. Because if they said, I made money in the stock going up or I made money in the stock going down, the question was just putting on a strategy that matched the trend. Does it make sense? So if someone did a bearish trade and made money, I don't think it matters. Does it matter? Okay. Now, if we take a look at this just real quick, we did the example on Disney, a bearish trade, okay? Now, I want to just show this for just a sec, just real quick, and we're going to look at an example, okay? When you look at Disney, is this a stock or an option trade? How would you know? It's an easy question, okay? It's an easy question because if you don't see any days expiration, it is a stock trade. Easy. Now, how do we know if it's a bullish or a bearish position? That's also easy if you know what to look for. Well, and that's why we're doing this. If the quantity says negative 50, you are short, okay, the shares. Now, we are in a margin account, meaning you already paid tax already, and then you put this in a trading account, okay? So you paid tax already, then you put it in a trading account known as a margin account. Now, if we take a look at this, if someone said, hey, I want to buy the shares of the stock, well, if you buy the shares of the stock, you're at negative 50. If you buy 50, it would actually get you to zero, which means now you don't have a position. Now, you would do that if you actually think, A, you want to profit take just in general, or you actually said, look, I actually think we could be near an area of support. So the investor staying bearish if they're seeing that technical analysis still bearish. So if we looked at this chart and said, do we see the technical analysis bearish? What would you say? Now that's a question to you. What would you say? Is the technical analysis showing signs of bullishness, or is it still bearish? Now, I think a lot of investors would say, James, I'm kind of seeing I don't see the price above the moving averages. And I would agree with you, it's not. I don't see any green on that moving average at all. Okay. I don't see that at all. We've got red shading because the 10 is below the 20. We might ask ourselves, are we at maybe a potential area of support? I mean, the area of support, probably the nearest area of support is right around 89.5. So on this one, we're not going to buy the shares back, okay? The thing that we could do is we could just say, look, there's the stop there. I'm going to move down the stop a little bit above that recent area where we fell down, consolidated, and I'm just going to move the stop slightly above that level. Now, guys and gals, you need to understand this, okay? In our lifetime, we are not so naive to believe that there's never going to be downtrends in our life. I think we should just come to the realization in our lifetime, there's going to be downtrends. And so with that, we want to learn the skills of the trading, the strategy of how to do that. We're picking different strategies because not all of us like the same strategies. We also might have potentially different accounts, etc. Now, all I'm going to do there is just move this stop down. I want to go back to Lulu here, and just if I looked at Lulu, let me go back to that NVIDIA and just see if we can't go back to that listing that we did, okay? Now, on NVIDIA, I think it was NVIDIA. Yeah. Gotta think of, okay. It's not showing at least there. Let me just go back to that just a second. Okay. I thought that's where we wrote it, but maybe I deleted that. Remember we said short stock, short call vertical, long put vertical, and a what's called as just short synthetic. Okay. Now, if we take a look at, let's say that, now, by the way, if you were to ask a question, why would someone do a short synthetic over a short stock? The major answer is it caps the loss. Okay. That's a big difference. Okay. Now, if we take a look at this, what I'm going to do in this case is I'm going to go back to, let's say, that Lulu. And if someone said, James, I think maybe Lulu could be at potentially big risk here of falling down through an area support and maybe even going lower. Now, if we did this, why don't people maybe buy puts? Well, they don't buy puts. In the words of the husband, I'm cheap. Okay. Now, is it completely that reason for everyone? No, of course not. Okay. Now, in this paid money account, the margin, there is a short position on Lulu. It's up 631. Now, if we go back to, let's say, buying the put, in 2 minutes or less, we're going to click on the at the money put. Whatever put that we buy, we think that stock could stay below that strike. Now, a lot of people say, well, if you buy a put at a higher price level, the stock has to go lower to break even. That's a true statement, okay? So if I click on that and say confirm and send just a long put by itself, the break even is at 143.85. That's the break even expiration. Well, some investors might say that's a low probability. The lower that break even is, the lesser chance we have to get to that point. We're going to go buy, we're going to go vertical, and we're going to buy the 155 and we're going to sell the lower strike. Well, what does that do? Well, number one is, in this case, so the 155 is what we had. There it is. But we're selling the 145 put. Well, what does that do? Well, you get a credit. Well, when you get a credit, it's going to lower the overall debit on the vertical trade. You lower the debit, it makes it where the break even is not as low. Okay? Why does that matter? Greater chance to be profitable. Okay? Now, built-in maximum profit, built-in maximum loss. Now, obviously, with these trades in closing here, you are wanting these stocks technically to be under pressure, but also with that fundamentally to be under pressure. Maybe the company's sales are struggling. Maybe with that sales, the earnings are struggling. Maybe they have leadership changes within the business. Maybe the consumer in general just doesn't want to buy their products anymore. They already have them. There's no new products and so on. So really, you would like to kind of maybe see an avalanche of issues where the stock price is reflecting that. Okay. Now I got to close it here. I want you to go out and practice some of these bear strategies. Why? Because there's some examples of trends. Why? Because I don't want you to be a one-trick investor where you can only try to benefit if the market goes up. Practice bears as well. That way you become more confident and competent in seeing different types of trends. Now we got Brett Crowther coming up next with short verticals. I'd like to actually thank Connie Hill for answering those questions in chat. Thank you. And thank you to all of you. I'll be back on tomorrow morning at 9:30 a.m. Eastern on ETFs. That is a live session only, so join us there live. And also remember, with what we discussed, all investing has risk. And this has been the class on Trading the Trend with a little bit more of a tilt on bearish examples. So thank you so much. Stay tuned for our next class coming up next. Bye-bye.